what is variance analysis? Before you can do anything on variance analysis, you must know what is standard cost and what is standard costing. Well, as a brought forward knowledge, you're expected to have knowledge of what is standard costing is and what standard costing is. Because what you're going to say is variance analysis and not standard costing. So go straight to a little revision. What is standard costing? What is standard cost? And what is a variance? I'm not dictating, I'm just discussing it, so I don't try to write at the pace of my thought. Standard costing is a process. As you have learned from your basic English, when you have costing, ing, it's a continuous process. So when I say standard costing, it means the process of using a standard cost in determining your cost of production or your cost of output. Now, what we mean by standard cost? You must understand what we mean by standard cost. And basically, a standard is like the yardstick. A standard is like an expectation, an estimate, a position to which we intend to compare performance to determine if performance is good or not. So when we talk about a standard cost, it means a unitary estimated cost of producing a particular product. Okay? If we know what the cost is, as long as we combine standard and cost, it means a cost that is estimated for producing a unit. I believe Samuel must have discussed something with you on budgeting and standard costing because they are related. While your budget is in total, that is, for you to prepare budgets, you have to consider total sales, total cost, total production, and all of that. But when you talk about standard cost, in the case of standard cost, it's referring to unitary. That is, the cost of a unit, cost of unit of output, unit of labor, unit of material, and the like. It's therefore imperative that when you add up standard costs multiplied by the output in quantity, you are going towards your budget. Now, what does variance imply? How does variance come into us in this discussion? Variance literally means deviation from what? From the expected. And so, if you have a standard, an expectation, you have the standard, which is your expected cost. You also have your actual cost per unit. That is what's eventually incurred during the period. The comparison of these two will reveal that there's a difference between them, and so that is what we refer to as your variance. Your variance is the difference between your estimated expected standard outcome and your actual outcome. I decided to use outcome because it cuts across every element of your operating statement. You have variances, sales variances, you have cost variances. The sales variances is divided into the selling price variance and the sales volume variance. What do we mean by sales price variance and sales volume variance? The price variance is where the selling price of a particular product is different from the expected selling price. There you have a variance. Now, when you calculate the variance of the selling price on a unit basis, multiplying it with the total quantity sold gives you what your total sales price variance. In the first place, you have sales variance. That is, your expected sales is different from your actual sales. The objective of variance analysis is to inquire why there's a difference between your expected sales and what your actual sales in revenue. And to do that, you need to break down what makes up my sales. Ideally, sales is what? Your price multiplied by your quantity. So if your sales or your revenue is different, there's a difference between your expected and your actual. These are the two things that you need to check. Was there a difference in my price? Was there a difference in the quantity sold? And that is what leads us to the price variance and the volume variance. If you are able to analyze the differences occurring between your price expected and actual, your quantity sold expected and actual, you will definitely be able to know the difference, the cost of the difference in your total expected sales and your actual sales. Any questions? None for now. Now, when we talk about the cost variances, you have broadly 4 categories. You have the material, you have what? Labor, fixed overhead, and variable overhead. These 4 categories have their sub-variances, but those 4 are the main variances that we have. Material cost variance is the difference between your expected material cost, which we refer to as standard material cost, and what? The actual material cost. To further analyze this, remember what we did is analysis. Variance is clear. What you want to do is you want to know why do we have these variances, what contributed or what has caused these variances. So, just like we did under the sales, when you look at material cost variance, you must first ask yourself, what are the 2 things that makes up my material cost? They are just like you have for the sales price. They are what? the quantity of the material used and what the cost of the material bought, cost per unit. So for the cost variance, material cost variance, you have the price variance and what? The usage variance. Price variance and usage variance. The price variance will occur where the expected price, the standard price of the material, is higher or lower than the actual material price. The usage occurs where the expected standard usage of material per unit of output is higher or lower than the expected or actual, difference between both. Similarly, you have for your labor cost variance. For the labor cost variance, we have the labor rates variance, labor rates and labor efficiency. Efficiency here, let's start with rate, is the same thing as price. Okay, so it's basically the same story as the previous ones, but the usage, the efficiency rather, talks about, or it means the no, not time saved. Efficiency is different from effectiveness. Efficiency means doing things right. Effectiveness is doing the right thing. Okay, so when we talk about labor's efficiency, it's referring to what is the expected time to be used for an activity and what is the actual time used. It might be time saved, it might be excess. Okay, so efficiency here will require you to be able to deduce from the question what is the expected rate of labor per hour. That is, what is the expected output of labor per hour compared to what they actually produce. You have a variable overhead where you have expenditure variance and you have the efficiency variance. Expenditure means the same thing as rate, price, and price. Efficiency in this case also means the efficiency under labor. Some persons will give you the number of hours for labor, but not for variable overhead. In that scenario, you assume the same number of hours for both. And the last, you have the fixed overhead cost variance. Here you have the expenditure and the volume variance. For the fixed overhead, the question might most likely not give you a specific rate per unit, but expect you to calculate what's called the overhead absorption rate. And so your knowledge of overhead accounting comes into demand. Expenditure is like, what's my budget for fixed overhead and what did I actually spend? For the volume variance, it's looking at what is my existing capacity, what do I have, what's the strength of my factory. For instance, if I have a factory that can work for 12,000 hours, but I only use 10,000 hours, that will result into a variance, which means my capacity is what? Underutilized. Your volume variance have two sub-variances. It has the capacity variance and the efficiency variance. These two will give you your volume variance. I'm not putting any formulas here, I'm not putting any calculations here now because I don't want to give you something to start cramming. Ideally, this topic has a lot of formulas, but I don't want to use formulas. I want to use a descriptive system or a narrative system so that you can put it in your own words, and if you want to understand it, you don't have to cram anything. So, for the volume variance that I explained earlier, you have a capacity which can be either well utilized or underutilized. The efficiency you have here now asks the question, how well was this capacity used? A combination of the usage of the capacity and how well the capacity was used is what gives you your volume variance. Now, when you add up all of this, that is the sub-variances, price and usage, rate and efficiency, expenditure and efficiency, expenditure and volume variance, it will add up to the major cost variance. All the other ones are sub-variances. Okay? However, there are instances of idle time. Idle time is a period when labor is not productive, but they are paid for it. When there is idle time, the addition of these two variances will not give you the cost variance until you bring in the idle time variance. Note that idle time has to be included before you can have a complete variance of the labor cost.